Welcome to Volume 5, Issue 21 of the Master Plan Investing Newsletter. This week's ex-dividend date is the 23rd of May 2019. Let us have a look at what happened last week, because we had an interesting week last week. Things didn't go as we expected. Let's see what happened. Okay, this is the FTSE 100. And when we were talking last week, this was Monday, right here. So we were basically had broken out of that down channel. It's a down channel. And we were in it for 2 weeks. And then we had broken out of it on Friday and we dropped back into it on Monday. So technically we were still in a down channel on Monday. And then what happens? Tuesday, Wednesday, Thursday, Friday happened. That's what happened. We essentially went into an up channel from Tuesday. And so any paradigms one might have been thinking about and discussing on the Monday obviously switched direction on us because the market switched direction. The market was going up. When the market went ex-dividend, we were very bullish. And then Friday, it kind of just, the upside kind of just weakened. And we had a kind of a small kind of, sideways downward facing day. If we look at the same chart from the perspective of a 15-minute candlestick, Wednesday we were going sideways. Then it jumped up massively in the afternoon and then petered off. Thursday, up, sideways, up, sideways, up. We were climbing up some stairs. And towards the afternoon, it got pretty aggressive. And then on Friday, we kind of went sideways, down a bit, up a bit, down a bit, up a bit. And we're up. Maybe market closed here and we opened here. So a little bit up. Now we saw a red candlestick. So on the date, why is that? Because it's counting it from here at midnight to here. So if you compare midnight to close of market, that's slightly down. But if we count from 8 o'clock until 4:30, slightly up. So that was the picture. And if you look at the candlesticks here, you can see some very aggressive volatile or very bullish kind of candlesticks, volumes, very, very high volumes. And they were spiking. Another spike right here. And then it was kind of tame. A little spike in the morning, a little spike in the afternoon. But essentially it was tame compared to Wednesday, compared to end of play Thursday. Okay, so our main candidates for last week were Tesco, Royal Dutch Shell, Intertek, Glaxo, and HSBC. Let's see how those companies fared. Let's start with Tesco. Now, based on what happened last year, Tesco was really the favorite for going long because the stats said that this one recovered in 2 days, on the very same day, so Thursday. It recovered Thursday twice. Now, but what was interesting about Tesco was that Tesco had very small fundamental, very, very low profits, and therefore, as a consequence, could only pay small dividends. So when they're paying small dividends, a small meal can be digested quickly, whereas a big meal will take a longer time to digest and therefore should recover on the upside, but take a longer time. Now, admittedly, I did kind of sound out my caution about it may not recover as quickly, but having said that, because it came out in the space of maybe a few seconds in a sentence, it may not have been picked up on. So I'm going to take responsibility for that because I did kind of indicate Tesco was a good one for going long. So I'm going to put my hand up and say that was my fault. But let's have a look what happened. Tesco is in the range between the red horizontal line and the green horizontal line. Now, Deducting the dividend from the closing price, we end up with break even at 238.54, and we end up with this as an exit point. If we take the worst price, the lowest price, we would adjust from here, break even. So if you've got the worst price, this would be a break even, and this would be your exit price. In point of fact, if we count it from the closing price and not the lowest price, this one delivered a profit, but not our target profit. Okay, so this mask scope adjustment, which is basically what we look at, was not something that was actually encountered or hit with Tesco. So Tesco had, and obviously we saw that Thursday was bullish. So we had a tug of war. We got a downward pressure and a FTSE upward pressure, and basically the upward pressure kind of won out in a way. It won out. And that was Tesco on Thursday. And then on Friday, we saw that the FTSE was kind of zigzagging sideways. And obviously this is doing the same, it's zigzagging sideways. So for long traders, you got your dividend, but you haven't got your money back yet. And for short traders who came in at this price, they got a little bit of profit. But if they came in at the worst price, this was just hopeless, okay? Because he doesn't touch the first blue line to break even. So this wasn't good for half the traders who came in at the very lowest end of Tesco, but it was okay for those who came in at the upper end of Tesco, okay? For short traders only. And for long traders, you still waiting for your money you got your dividend, but you're still waiting for your money to come back to you. And what's interesting as well, for those who got the best price, you're in profit. Why would that be? Well, this is, if you're long and you came in at the best price here, the share price has to go to the blue line before the share price, before the capital adjustment downwards is equal to the dividend you received. And so effectively the dividend you received is greater than the downside adjustment, the capital adjustment, so therefore you're in profit. And you stayed in profit the whole time. For those who got the best price going long, you're in a profit. But everybody else, Tesco was kind of a little bit miserable. It didn't really it wasn't a stellar performance for either short or long traders. The next one, Royal Dutch Shell. Red line is the lowest price on Wednesday. The green line is the highest price on Wednesday. That's the range for Wednesday. So we can see that towards the end of the day, it was kind of bullish, a bit like the FTSE 100. And then it gapped down. And based on the closing price, it should have gapped down to this purple line right here, just above the red. And then your exit price would have been here at 2473.8. However, what does it do? It gaps down and it gets caught up in this upward draft. And this draft literally lifted its wings and as it floated up. And you can see literally it touched the exit point for everybody who came in long at the worst price. So everybody got paid right at the end of the day if you caught it. And if you didn't catch that, you definitely got your money back on. You had the opportunity to get your money back again on Friday. Friday morning, obviously people selling off right here. You can see a big sell-off right here, a spike on the volume, people taking their profits, but the upward pressure was very strong and it just floated right back up again. So anyone could take their money now at the higher levels, okay? Because everything above the green line means that everybody who went long has gotten their money back. Royal Dutch Shell was absolutely brilliant for long traders. Long traders received the dividend equivalent to 28.6%, and they got their initial investment capital back 2 days later. They came in on Wednesday and they came out on Friday. Now, to get 28% in 2 days, that's not shabby at all for professionals. Non-professionals got 7%. And again, 7% in 2 days, I'm not sure many people could argue with that. That was Royal Dutch Shell. When it comes to going short, well, you know what? Anywhere between -28 and 2% for professionals, -8 and 0% for non-professionals on the short side for this one. So this was not a good one for going short, but absolutely brilliant for going long. The next one in our resume of stock last week was Intertek. What were they saying? Red line is the lowest price on Wednesday. Green line is the highest price on Wednesday. Why is Wednesday relevant? Wednesday is the final qualification date to pick up dividends. So what have we got here? We have it gapping down, and based on the closing price, the dividend adjustment should come to here, and then you've got the milescope adjustment. This would be here at 5004.63. But what does it do? It hits the break-even point where the dividend adjustment line is, and then it flies up from there. It flies up. It runs out of steam. Remember, Thursday was a bullish day, so we know what was going on here. The rising tide of the FTSE raised all the ships in the water. So we've got this upward pressure, okay? For everybody, apart from the top end of these four candlesticks, so from 3 o'clock until 4 o'clock, everybody who came in before 3 and after 4 got their money back. That window of 3 to 4, the top end of 3 to 4, those guys are still waiting. Everybody else got their money back, and you got it back in one day. You came in on Wednesday, you got your money back. You had the opportunity to get your money back on Thursday. Then it gaps down, and then it starts to drift down. It hits the lowest point it was on Wednesday, which is red line. It uses that as some kind of support, and it bounces off it. And it basically settles in the 5083 range. So great for long traders. Short traders, Now, remember, we were in a FTSE 100 rising channel. Remember that. Had you gone long and you got your money back, you would receive a dividend of 26.2% for derivative traders, or 6.5% if you were non-professional. 26.2 as a professional, 6.5 as a non-professional. Glaxo. Glaxo is in the range between this green line and the red line. This is the range here. It's quite thin. It's just gently moving along, but it's going upwards. Hit the ceiling just after 3 o'clock, and then basically starts to drift down. What happens on Thursday? The dividend qualification takes place. It goes now ex-dividend on Wednesday. On Thursday, it gaps down and it starts to move down. It hits the lowest point it was on Wednesday. It uses that as support and starts to float back upwards. Okay, by about 1 o'clock, just after 12, let's say 1 o'clock on Thursday, you get the opportunity to take your money back, your original capital. Okay, it dips a bit below around 2:30, and it bounces right back up again. So from 3 o'clock onwards, everybody can get their money back. Everyone got their money back. So Glaxo, brilliant for long traders. Short traders had a horrible time. Friday, it went up some more, and then it started to kind of float around. And then towards the end of the day, it started to again rise higher, ending at 1555.2. And the highest price on Wednesday was 1538.7. So you can see that everybody by Friday had the opportunity to get their money back. Glaxo, had you been long, you would receive a dividend equivalent to 24.7% with a derivative. And as a professional, non-professionals got a 6.2% dividend using the derivative. And look at this. We can see that essentially this week was a great week for long traders. What can we see here? We can see a 6.2, 6.2 plus your money back and a little bit of premium. If you got, if you waited and got a premium, if you came at the red line, then all of this is premium. But if you came in at the green line, everything above the green line is premium, depending on when you came out. Glaxo, great for long traders. For short traders trying to go for the drop, appalling. HSBC. Let's see if HSBC can give respite to the short traders. HSBC trading on Wednesday, the qualification date for dividends, between the red line and the green line. Bobbing along, as we can see. It gaps down because it paid a dividend. The dividend adjustment based on the close price was around 654, which is this line here. And then the milescope adjustment says that it should come down to here. And then from there, that will use that as support. What does it do? On Thursday, it basically finds support between the lowest price and the dividend adjustment price. Then it basically floats up, hits the moving average on the Bollinger Band, and then it floats down again. And then it breaks through and then basically stays on the upside of the Bollinger, on the upper half of the Bollinger, and then it basically heads for home. Everybody who came in this stock got their money back, for those who, and only those right at the top, which would have been around maybe 3:15 to 3:45, that half-hour window, and maybe right at the end, those guys didn't get their money back. Everybody else got their money back with HSBC. Long traders, what did you get? A professional got 23.2%, a non-professional got 5.8%, and they got their money back the very next day. Long traders paradise is what took place last week. Let's look at Friday. Friday, once it basically had paid everyone their money back, there was no need for it to be there anymore because the upside pressure to get your money back is gone. And what happens? It gaps down, and then it basically drifts along back to where it should be. So remember, for fundamental reasons, this top purple line is where the price should be. You talk to your accountants, this is what they're going to tell you. Yeah, if you were to look at an accounting textbook, they're going to tell you this is where it's supposed to be, right here. This first purple line. And then it hits that as support and it bounces back up again. And then there's obviously the Friday was a quiet sideways day. And so basically this one starts to drift down, with very little momentum. It starts to fall. And it basically hits the line based on the milescope adjustment. Well, it doesn't quite hit it, but it goes near there. And then from there, it uses a number slightly above that as support, and it starts to float back up again. Okay, it closes the day at 655.3. And so, for long traders, they got their money and they were happy by the Thursday. Short traders, had you kind of, just ignored the pain or didn't see it or, weren't spooked out of the market, short traders, got a profit on Friday. Okay. But it's more than likely, nervous traders would have got spooked out on Thursday, and so they wouldn't have benefited from that. But had you, stayed the course, the short traders, so here's how you do it. From the red line to the first blue line would be, if you got the worst price, the first blue line is where you break even. You can see here short traders at the worst price did not go anywhere near that. anywhere from the closing price, you made a profit. So short traders made anywhere between -4% and +11% for professionals, and non-professionals from -1% to +3% is what was available to you on Friday. So that is the post-mortem analysis on last week. So for those of you who did well, well done. And those of you who struggled a little bit, absolutely something to be learnt from that. And what the learning point is this: when the FTSE is marching up, long traders can expect to do well. And when the FTSE 100 is marching downwards, the short traders can expect to do well. And so because the market switched off on Tuesday and started to go bullish, anything I said last Monday, bearing in mind we were in a down channel, kind of became invalid. And so this is one of the reasons why you need to pay attention to what the market is doing when you're live, what's it doing, and not what it was doing 1 week before that. But there we go. Lessons to be learned there. Okay, what can we expect this week with the dividend date of the 23rd of May, 2019? We've got 5 candidates: Morrison Supermarkets, Imperial Brands, Carnival Corporation, Bunzl, and DCC. We can see that there's £1 billion on offer, with the biggest payers being Imperial Brands at nearly 300 million. We've got Carnival Corporation at 290 or 286 million, and then we've got Morrison's paying out 209 million. Bunzl 118, rounded up, million, and then we've got DCC at 92 million. The whole thing is £1 billion, and let's have a look what's going on. For professionals, we can see that the dividend of 4.1%, and that's huge, by the way, of 4.1%. Morrison's is literally being very generous. And for those who can get the 5% margins, that's going to, on a derivative, that's going to be equivalent to your 83% return on investment. Okay, 83% for professionals and 20.7% for non-professionals. So this is a number we definitely need to pay attention to and see what we can expect from that. And we'll look at that later on. Imperial Brands, a more respectable 28.9%, Carnival 19.8%, Bunzl 16.5 and 13.4 professionals, and we've got 7.2, 5%, 8.3, and 6.7 for non-professionals. If you're going to buy the share, you're going to receive a dividend anywhere between this 14th of June or the 18th of July, in that range, between 3 and 8 weeks. Okay, and if you're going to go for the derivative, you'll receive your dividends on the 23rd of May, 1 day later, for the derivative traders. Okay, let's jump straight in. Morrison. Morrison Supermarket is engaged in the operation of retail supermarket stores under the Morrison's brand and associated activities. The company offers products such as Freeform, World Foods, Food to Go, and Nutmeg clothing. It has food manufacturing capabilities in meat, fish, bakery, fruit and veg, deli, and flowers. Its Morrison's branded beef, lamb, pork, chicken, milk, and eggs are sourced in the United Kingdom. The company serves customers across the UK through approximately 500 stores and an online home delivery service. It operates from over 10 manufacturing sites across Britain. The company operates over 7 regional distribution centres and a national centre servicing its supermarkets. Its subsidiaries include Boss Brothers, Fruit and Veg, BV, Erith Pier Company Limited, Fursdale Limited, Kiddie Care Properties Limited, MHE JV Co Limited, Nerock Farming Limited, Nerock Limited, Rathbone Kia Limited, and WM Morrison Produce Limited. What you can see just from that little list is that they are vertically integrated. So what does that word mean? A vertically integrated company. It means that the shop itself owns, and not only does it own the retail outlets, but it also owns the suppliers. So in other words, instead of buying from a farm to then service Morrison's, it owns the farm that services Morrison's. So this is what I mean by vertical integration. Not only does it own the retail outlet side, but it owns the supplier to the retailer. So typically you would get a retailer buying from a wholesaler, buying from a manufacturer stroke a farm. And in this case, they own the whole chain. They own all three of those segments. That's what they're telling us here. David Potts is the CEO and Trevor Strain is the CFO. They're worth £5.1 billion if you bought all the shares at the current price. And they're number 87 in the FTSE 100. So in the last 6 years, had you bought this company for its dividends, you would have had 13 opportunities to trade this stock. 7 out of 13, 54% of the time, you would have gotten your money back within a week had you traded this. Once, it would have taken you 8 days, which is obviously more than a week and less than a month. And that's 8% of the time. And 5% of the time, it would have taken you more than a month to get your money back. Anywhere between 36 days and 415 days. That's over a year. But essentially, in the last 6 years, everyone got their money back if they had been hanging around and waiting. And that is 38% of the time. What about for short traders? Well, had you been a short trader and you went short 5 times out of 13, which is 38% of the time, you would have made money going short on day 1, and 54% of the time, which is 7 times out of 13 on day 2. Your ROI was anywhere between 5%, 4%, and 54%. Now, 54 is clearly an outlier. So the next best one is 12%. So, you know, between 4 and 12% is your typical ROI. And for that was day 1. And day 2, anywhere between 1 and 35%. Again, 35 is an outlier. So the next best is 15%. So anywhere between 1 and 15% is what you could expect for this one on day 2. Let's look at their fundamentals. What's the balance sheet and the saying here? Or what's their numbers saying? So let's look at their revenue. We got 16.8 billion in 2015, and that drops to 16.1. It bounces up 16.3, up again 17.3, and up again 17.7. So really, from 2016 onwards, we're marching up. In 2015, they reported a £792 million loss. So clearly 2015 was ugly for Morrison. They then get back on track with in 2016 with a £217 million profit, £325 million profit. The following year, 380, and then it drops by 60 million in 2019. The profit does to 320 million. And again, we can see by looking at these two numbers what's going on right here. So basically, for every £100 they sold in the shops, received in the shops, £2.20 became profit in the bottom line, compared to £1.80, 1.8%, £1.80 being profit in the bottom line. And they're basically, you can argue that there are some costs that they haven't quite got under control. It could be, and obviously with a supermarket, there are things you really can't easily manage, like wastage of food, people nicking your stuff in the shops. Now, yes, you can hire security and you can put cameras in the shop, but the truth is cameras and security can't stop everything disappearing off the shelf inappropriately. And and people don't buy the things quick enough, and it goes off, and it has to be thrown away. So you can get costs slipping from those reasons. But if you can manage those processes quite well, you should be able to make this work for your benefit. And clearly they're going to have a percentage slippage or a percentage wastage number, which they're going to be working with. And as long as they don't breach that number, then everything is kind of basically under control. Let's have a look. Now, these guys wanted to pay a dividend of £209 million. Well, they have profit of 244, and they've got cash in the bank of 264. So I would say that these guys are, okay, these guys are catch rich, right? Because when you go in the shop and buy the stuff, you have to pay for it cash, but they haven't got to pay their suppliers, which they own, but they haven't got to pay their suppliers for 30 days using normal credit terms. So effectively, retailers are going to basically be quite liquid because of that phenomena. All right. We also said that this company was worth, we said they were worth 5 billion, 5.1 billion. The balance sheet, this means all the assets minus all the liabilities. In other words, if you basically was just buy the company and then scrap it by selling off all the assets, paying off all the liabilities, and leaving behind what was left over, you were left behind with 4.6 billion. They're for sale for 5.1 with a 4.6 billion book value. Do you know what? Their share price is kind of, I would say that, technically most people's stock market price is higher than their book value in most cases. But this is practically the same. I know it's 4.6 going to 5.1, but I would say that this is fair. This is a good price. It's a good price. However, if you look at their profit margins, it's 1.8%, 2.2%, 2%, 1.3%. These are very, very thin, meaning when you get into problems, you notice it straight away because you don't have too much fat, or too much meat on the bone of this particular business. So businesses with very thin margins, as I keep saying, when you've got a very, very thin profit margin, unless you have got high volumes, this can't work for you. So remember, all entrepreneurs who are in business and you want to give away your products for cheap or free, or not free, but cheap, because people ask you for discounts, be careful. Thin volumes, thin margins will hurt you, and it will make you basically non-viable as a trading business entity. So be very careful of this. You need generous margins if your volumes are low, and most small entrepreneurs, their volumes are low. But here's an advantage that these guys have, because they have the ability to scale. They can actually reduce their prices to much lower than you could if you had a corner shop. If you had a corner shop and you were selling the equivalent of what Morrison's was selling, you could not sell as cheaply as they could and be in business, because if you had these thin margins, you'd go bust. So this is where their buying power is really working in their favor, because the bigger you are, the cheaper you can sell your products for and still make a chunk of change. So it is what it is. Something to think about, really. Okay. Next one. Let's look at the 5-year trend. So we saw that from 2016 onwards, their profits were going up. Apart from 2019, profits were going up, and the turnover was going up. Okay, what was the share price doing over that same period? Well, we can see from 2015, it's trending up. It comes down a bit at the end of 2017. It starts to go back up again in 2018, and now it's on a downtrend. So really, from the middle of 2018 onwards, September, this has been falling. It's been in a downtrend. And you can see that it's coming close to the bottom of the Bollinger, but it could push it down. But if you look at the RSI, RSI is in the middle. So this could still fall some more and still be fair value. It could fall some more. So we can see that the drop in profits, this drop in profit has softened the share price. So we're in a downtrend, and we've been in a downtrend really since September last year. That's Morrison's. Imperial Brands, formerly Imperial Tobacco, is a fast-moving consumer goods company. The company offers a range of cigarettes, fine cut and smokeless tobaccos, papers and cigars. The company's segments include growth markets, USA, returns markets north, returns markets south, and logistics. The growth markets segment includes Iraq, Norway, Russia, Saudi Arabia, and Taiwan, and also includes premium cigar and Fontem Ventures. The returns market north segment includes Australia, Belgium, Germany, the Netherlands, Poland, and the United Kingdom. The returns market south segment includes France, Spain, and its African markets, including Algeria, Ivory Coast, and Morocco. Its businesses include tobacco and logistics. The tobacco business comprises the manufacture, marketing, and sale of tobacco and tobacco-related products. The logistics business comprises the distribution of tobacco products for tobacco product manufacturers. Alison Cooper is a CEO, and Oliver Tant is a CFO, and they were worth 20.5 billion, and they're number 24 in the FTSE 100. In the last, these guys paid dividends 4 times a year, and in the last 6 years, excuse me, you would have had 22 opportunities to trade this company. 9 times out of 22, had you gone long, you'd have got your money back within a week, which is 41% of the time. Twice out of 22, which is 9%, you'd have got your money back more than a week, less than a month. 7 times out of 22, which is 32% of the time, it would have taken you more than a month to get your money back. The longest wait was 414 days, over a year, and the shortest one was 36. And 4 times in the last 6 years, you would not have gotten your money back at all. That's 18% of the time. And you can see on the screen, 1,001 days, 728 days, 266 days, and 84 days have elapsed since those 4 times. Had you been long and you're hanging around with that high-priced share, this would not be a pleasant company in your portfolio. What about short traders in the last 6 years? 13 times out of 22, which is 59% of the time, had you gone short, you would have made money on day one. The range of return on investment was anywhere between 2% and 29%. And 29% is not a big outlier. The next best after 29 is 23 twice, and then you're into the teens, 19, 18, and so on and so forth. On day 2, 12 times out of 22, which is 55% of the time, you made money on day 2, going short. Return on investment, anywhere between 1% and 70%. 70 is a bit high. The next best after that was 55. Then after that, next best is 18. So you got 70, 55 as outliers, and then basically you're in the teens and single digits. So 10 times, 10 times was anywhere between 1 and 18%. actually 20%, beg your pardon, 1 and 20%. So let me just count the double digits. 1, 2, 3, 4, 5. You got 7 double digits, 5 of which are between 12 and 20, and then the others are single digit numbers. Imperial Brands. Fundamentals, what are they telling us? Revenue in 2014 was 20.6, was 26.5. It dropped to 25.3. It bounced up to 27.6, up again 30.2, up again 30.5. The profits, 1.5 billion, up to 1.7 billion. In 2016, profits dropped to 907 million. Back up again to 1.8, 1.9, and then down a bit to 1.8. That is how they fared. If you look at their profit margins, we're ranging anywhere between 3%, which is the ugly month, or the ugly year, sorry. Put that to one side, you got 5.8 and you got 6.9. So they're really in the 6% range. These guys are, putting out 6%. You can argue that's their number. Again, it's quite thin, but like I said, you have to have very large volumes to make thin margins work for you. And in their case, they're doing it. So well done to Imperial Brands. We said that Imperial Brands had a value of 5.1 billion. I'm sorry, not Imperial Brands has a value of 20.5 billion. And if you look at their net assets, they're only worth 6.5. So if I take 20.5, divide that by 6.5, I get the number 3. So they're selling, their share price is selling at 3 times their net value, their book value, as it's called, the book value, 3 times their book value. So interpret that how you will. Just one last thing. If you look at the P/E ratio, it goes from 18 to 21. Obviously, this one is that was caused by the profit dropping massively and the price going up. So that's interesting. The price goes up and the profits go down, and the P/E ratio is in the range of 16. Now that's a joke, but their correct range is anywhere between 18 and 21. So, and then again, they're back to where they should be. So, as long as they can. Now, so here's a question: what should it be? Well, it's what they can sustain. If they can sustainably be anywhere between 18 and 21%, that's their range, and they're showing it right here. That's their range. And so, apart from that 1 year, this is where Imperial Brands are at. Let's look at their 5-year trend. So I want to see what that was. Obviously in 2016 when they had the ugly year. So that would have affected maybe 2017's numbers when they got reported. So let's have a look. This was marching upwards, and then it peaked in 2016, and then it came down a little bit, went up again in 2017, and then from 2017 onwards, this has been dropping. This has been declining. Okay, share price declining. So let's go back up here and see what's going on. So we just said from January, February, March, April. So from March, April, the price peaked and it's been falling ever since April 2017. And if I go back to here, so even though the profits are rising, the share price is falling. So you had a profit rise here and then it softened here. So basically, Imperial Brands are basically the share price is softening. And if it keeps on, in this down channel, then you're going to get, a cheaper price. But remember, they are 3 times their book value. So, depending on how you want to interpret that number, we can see that they're near the bottom of the RSI range. So they're pretty much as cheap as they're going to get, based on technicals. So you could expect them to kind of maybe, you know, be finding support soon for this one. But that's Imperial Brands. Carnival Corporation is a leisure travel company. The company segments include North America and Europe, Australia and Asia. Its North American segment includes Carnival Cruise Line, Princess Cruises, Holland American Line, and Seabourn. Its Europe, Australia, and Asia segment includes Costa Cruises, Ada Cruises, P&O Cruises, which is the UK, P&O Cruises, Australia, and Cunard. It also includes Cruise Support segment, which represents its portfolio of port destinations and private islands. In addition to its cruise operations, it owns Holland America Princess Alaska Tours, a tour company in Alaska and the Canadian Yukon. Its tour companies owns and operates hotels, lodges, glass-domed rail cars, and motor coaches. Its Carnival Cruise Line offers cruises generally from 3 to 8 days, with almost all of its ships departing from 16 convenient United States home ports located along the East, Gulf, and West coasts, Puerto Rico, and Hawaii, as of November the 30th, 2016. I hope you noticed what I saw here. They own private islands. They own some islands, no doubt, for their destinations. They're number 55 in the FTSE 100 with a valuation of 7.6 billion. Okay, these guys pay dividends 4 times a year. In the last 7 years, you would have had 30 opportunities to trade this company for its dividends. 19 times out of 30, which is 63% of the time, had you gone long, you got your money back within a week. 6 times out of 30, 20% of the time, you got your money back within a month, but more than a week. And 5 times out of 30, it took you more than a month to get your money back. The longest was 216 days. And that's 17% of the time. What about going short? Going short on the Thursday, going short 9 times out of 30, which is 30% of the time, you made money going short. Your return on investment was anywhere between 7% and 53%. The next bet is 41, and then after that, it drops into the 20s. And Carnival on day 2, 11 times out of 30 made money, anywhere between 2% and 114%. If we look at the 114, next best off, that's an outlier, clearly an outlier. And then you've got 40, 34, 30, 28. As you know, before they got 61%. So this one, you know, it can get volatile. It can get volatile on the downside. And that's 37% of the time. So let's look at their fundamentals. We can see that revenue in 2014 was 15.9. It dropped to 15.7. It bounced up to 16.4, up again to 17.5, up again to 18.9 revenue. Profits, 1.2 up to 1.8, up to 2.8, down to 2.7, and up again to 3.2. So this has been rising up with a little blip in 2017. This is rising. They want to pay dividends. Carnival wants to pay dividends of 287 million. They have profits of 3 billion, and they've got cash of 982 million. So they're good. They can pay that. They're clearly not storing their profits in cash though, because 3 billion and then less than a billion cash. Interesting. Okay, so what did we say there? What were they worth? Carnival, had you bought them on the stock market, we said they were worth 7.6 billion. And their book value is 24 billion. I think we've got a discount on our hands here, fellas. Their net value, their net book value is 24 billion. Now that's because obviously they own islands, they own resorts, they own cruise ships, and so on and so forth. Now your cruise ships are like motor cars, that's a depreciating asset, but they clearly own some appreciating assets too in the form of islands and property and so on and so forth. But when you're talking about 24 billion pounds book value, and you can buy them at 7 billion, this is a bargain. Now, again, it depends on, you know what, you're buying below book value. And I don't know if you remember, I don't know if you actually ever looked into Warren Buffett and his style of trading, but Warren Buffett said he used to try and buy companies that are selling at a discount on their asset or book value, or the true value. Well, right here is an example of that. 7.6 value. If you bought all the shares right now, you would basically be buying them for 7 billion. And if you did, you've got 24 billion asset on your hands. I don't know. As long as those numbers are not dodgy, where you've got things which are not real in that number, this looks like a discount. So just so I'd let you know what I'm looking at. Okay, let's look at their profit margins. Now, their profit margins is between 8% and 17%. And in the last 3 years, they're in the teens. That's their profit margins. So it's increasing. They're actually, doing good. What about their trend? Before I look at the trend, I want to see what's going on here. So the profits went up, down in 2017. You would have seen that in 2018. But yeah, they've been moving up. So what's the share price saying? The share price is moving up, and then it starts to soften at the end of 2017 and starts coming down. And they've been a downtrend really since 2017. So where did the problem come for them? It was in 2017. Yeah, there was a problem in 2017. It's bounced up in 2018. They are setting at a P ratio of this between 18 and 10, with 10 at the moment being what they're at. But you know what? This looks like it's cheap. This company's cheap. It's cheap on its book value, and it's cheap as a 10. Now, what is the range for this company? Well, this company goes from 18 to 15 to 11 to 13 to 10. I mean, the P ratio is dropping. Carnival. So in a recession, would this company struggle? And obviously the answer is, when people are broke, they don't go on holidays, especially expensive holidays. So these guys are not recession proof. So you be a little bit wary about jumping in on them just blindly, because in a recession, they'll get hurt. And just because of the nature of their business, they're not like selling food where you have to buy it whether you're broke or not. You have to eat. Whereas you don't have to go on cruises when you're broke. So these guys are not recession proof, but nonetheless, they're selling at a discount on their book value. But be wary. These guys are vulnerable to recessions because of the nature of their business. You can see this, even though it's been coming down, RSI is in the middle, so it could keep on coming down, to be blunt. But the MACD histograms are beginning to kind of change direction and go up. So you can see that the fall is kind of coming to an end. So you could argue that it's about to go up again. And bearing in mind, I already said it was cheap. As long as we don't come up, as long as we're not coming up into recession in the next couple of years, this is good value. Bunzl. Bunzl PLC is engaged in the distribution and outsourcing service. It supplies a range of non-food products to a range of market sectors. Its segments include North America, continental Europe, UK and Ireland, and the rest of the world. It serves 6 market sectors, including food service, which offers non-food consumables, including food packaging and guest amenities, to hotels and restaurants. Among others, groceries, which includes foods not for resale, including films and labels, to grocery stores and supermarkets, among others. Cleaning and hygiene, which offers materials, including chemicals and hygiene paper, to cleaning and facilities management companies, amongst others. Safety, which offers personal protection equipment to industrial and construction markets. Retail, which includes goods not for resale, such as packaging and other store supplies, and healthcare, which offers disposable healthcare consumables, including gloves and bandages to hospitals and care homes, among others. Frank Van Zetton is the CEO, and then you've got Richard Howes, Chief Financial Officer Designate, and Brian May, Finance Director. What are we saying here? This company's worth $7 billion. They pay dividends twice a year. In the last 6 years, you would have had 12 opportunities to trade this company. 8 times out of 12, 67% of the time, you would have gotten your money back had you gone long. 2 times out of 12, 17% of the time, it would have taken you more than a week and less than a month to get your money back. And 2 times out of 12 in the last 6 years, so which is 17% again, it took you more than a month to get your money back. The longest you had to wait was 562 days, which is obviously nearly 2 years. Had you gone short, 3 times out of 12, 25% of the time you made money on day one. Twice it was 3%, once it was 14%. And twice out of 12, 17% of the time, you made money going short on day 2, 10% and 1%. This is telling me this is not good for going short, Bunzl, okay? Bunzl does not have a good track record or a healthy track record of rewarding short traders, and long traders are better served by this specific company based on its six-year track record. Let's look at their fundamentals. 6.2 billion, up to 6.5 billion, up to 7.4 billion, up to 8.6 billion, up to 9 billion. They're marching upwards. Profits, the key number, 300 million, 323 million, 363 million, 509 million, 425 million. Everything is marching up. Their profit margin is basically between 4.7 and 5%. Again, thin margins, but high volumes, and this business can make this work. We said that if you bought them on the stock exchange, they were worth 7 billion. Their net assets is 1.7 billion. So they're selling at a premium of their book value. They're selling at 4 times their book value. Okay. Now their profits are marching up, so they're obviously pretty good. And what can we see about, if we look at their share price, they're in an up channel. They've been going up the whole time. Only in the last 2 months have they dipped. And yeah, so the last 2 months they dipped, which is April, May. But apart from that, they've been moving around. But you can see here also, towards the end of 2017, they also dipped, hit the bottom Bollinger, and then came back up again. It's possible. But also this Bollinger, if you look at it for this year, or so since 2018, we're in a sideways Bollinger. This is sideways. Up here, floor, hit the ceiling, back down to the floor. This is really sideways for the last year and a bit. And prior to that, it was going up. Bunzl. Okay, this is the last one on the list. DCC is an international sales, marketing, distribution, and business support services company. The company has 4 operating segments: DCC Energy, DCC Technology, DCC Healthcare, and DCC Environmental. The company's DCC Energy segment operates through 3 businesses: liquefied petroleum gas, oil, and retail, and fuel card. Its DCC Energy segment is engaged in oil distribution in Britain, Sweden, Australia, Denmark, and Ireland. Its DCC Technology segment is engaged in sales, marketing, distribution, and supply chain services. Distribution and supply chain services business providing a range of consumer and business technology products and services to retail and reseller customers in Europe. Its DCC Healthcare segment provides healthcare business providing products and services to healthcare providers and health and beauty brand owners. Its DCC Environmental segment provides recycling, waste management, and resource recovery services to the industrial, commercial, construction, and public sectors. Donald Murphy is the CEO, and Fergal O'Dwyer is the CFO. So sound like 2 Irish lads there running this company. This company is number 61 in the FTSE 100 with a valuation of 6.9 billion. In the last 7 years, you would have had 15 opportunities to trade this company for its dividend fishing opportunities. 9 times out of 15, which is 60% of the time, you'd have gotten your money back within a week. 4 of those by the Thursday, the very next day. 5 times out of 15, which is 33% of the time, it would have taken you more than a month to get your money back. And once you didn't get your money back at all, and 359 days have elapsed since that time. 8 times out of 15, which is 53% of the time. Let me say it again, sorry. 7 times out of 15, which is 47% of the time, you made money going long. Your ROI was anywhere between 5 and 26%. The next best from there is 18, and then it drops to 11, 10, and then single digits. 9 times out of 15, which is 60% of the time. On day 2, you made money with this one. ROI anywhere between 4% and 24%. You got 2 single-digit numbers, and you got 7 double-digit numbers. And the double-digit numbers are ranging anywhere from 11 to 24%. Okay. Their fundamentals is telling us that in 2015, they had sales of 20.6 billion, then it dropped to 10.6 billion, then it dropped to 10.4, up to 12.3, up 13.1, and up 15.2. So from 2016 onwards, numbers are positive. Let's have a look at their profits. 147 million, up to 203, up to 248, up to 260, up to 327. So this is all positive. All positive. All positive. Okay, let's look at their chart in terms of the last 5 years. Each of these charts, by the way, are monthly. And you can see they've been up channel. They hit a peak around here. They dropped a bit, hit in the middle of the Bollinger with more upside strength. They just kept on marching up. Broke the middle of the Bollinger, went sideways for 2018, dipped at the end of the year. And this year, they've been marching up again. The share price has been marching up again. So whatever was spooking anybody about this company, you know, they're going up. Let me just go back to their numbers again. What did we say? We said DCC was valued on the stock market at 6.9 billion. They've got assets, their net book value is 2.4 billion. So again, 6.9 divided by 2.4, we get a premium of 2.9. Let's call it three times. So they're selling at 3 times their book value. Okay, not outrageous, but it is what it is. Their profit margin, oh Lord have mercy, is between 1.4 and 2.1. This is super thin. Wow. Wow. And then we have a P ratio in this range, anywhere between 32 and 24. And it's kind of at the bottom end now. Again, this is kind of a healthy P ratio, which means that they're kind of, you know, someone fancies this company and they're kind of, you know, giving it, they're saying this can sustain the values. And so, or it can sustain this, this P ratio. With these super thin bonds, you know what? Hey, as long as they keep on making more money into the future, this will be sustainable. They are, let me set a business model. They're in the business of providing business support services. Okay, I suppose in their model, business support services is not going to go away. People are always going to want to know, going to want what they want. They're going to want what they have to sell. So there is that. All right, so what's our summary? Our summary is that on the long side, Carnival and Bunzl at 67 and 63 have the best track record of rewarding long traders. Morrison's at 54 is kind of above 50%. So, you know, it's just edging it a little bit. But if I look at, for short traders, we've got 17 here, which is the worst, and 25. And so if you want to go with a company long, you want the long trend to be good and the short trend to be rubbish. And I would say this one meets that criteria. So Bunzl really is the best for rewarding long traders. And on the short side, the best ones would be Imperial Brands for short traders, followed by maybe Morrison's and then DCC. But if we look at this detailed analysis right here, we can see that this is how long it takes to recover. Carnival in the last, since the end of the last quarter, sorry, the last half of 2018, having 1, 1 and 0. And then you had these big long waits. And then after that, again, short waits. So the recent history, with the exception of the beginning of 2018, is that they give you back your money quickly. That's Carnival. Imperial Brands, 86, well, this is not even recovered, 86 right there. And the last time, 81 days, 267 days, 36 days, 76 days, and then it gets kind of reasonable. And then again, you got an ugly one, 730 here, and 1,000 in 2016. I don't know what to say other than, wow. And these gaps represent, because around this time, they were paying dividends twice a year, around this time. And then they switched to, in 2015, they switched to paying dividends quarterly. So this gap isn't that they weren't paying dividends, it's just that they weren't paying dividends quarterly. Let's look at Morrison's. Morrison's returns you money relatively quickly, with the exception of this horrible 415 in beginning of 2018. But you know what? If you take that one out of the way, Morrison's is not that bad a performer on the upside, you know. Not bad performer. DCC, it took 369 days and then 59 days, and then it was okay, and then went big numbers, and then it was okay again. So this one's inconsistent, DCC, for rewarding long traders. And then we've got Bunzl, 1, 20, 4, and then you got this huge long wait. And then you got 5, 36, 0, 8, 0, 6. So, okay, they're really good. So even though this one said 60%, it was really most distant history. The recent history is more shaky. It's shaky. So from end of 2017 or 2017 onwards, it's inconsistent. Long wait, short wait, long wait, short wait. It's inconsistent going forward. So if you're going to go long, it looks like Carnival has the best recent track record of rewarding long traders. And then you got this little run here, you know, from 2016. And then you got this hiccup right here. And then you got a nice little, again, good results for short traders, for long traders, sorry. And then Morrison's, again, not too bad, apart from this 2018 horrible nightmare. For anyone who went long, this would have been a nightmare. And it's funny, actually, because my memory of Morrison's, when I was trading Morrison's back in 2013 range, I don't have pleasant memories of Morrison's being a good company for going long. Because back in those days, I was going long only. And I don't have a good memory of them. So I must have got caught up in this 82-day business. Because this one left a bad taste in my mouth when I was going long and had to wait forever to get my money back. So Imperial Brands, well, this is ugly all day long for long traders. So you might argue that Imperial Brands is a good one for maybe going short. Let me look at their return on investment. Imperial Brands, we are talking about ROIs day one between 2% and 29% on day one. On day two, between 1% and 70. 55 being next best, and after that was 20. What can I tell you? And then you got some thin ROIs after that. Well, the numbers are there, so you can actually look for yourself and make your own assessment. So if I was going to go short, I might lean towards Imperial Brands for going short. And if I was going to go long, based on the stats, historical stats, I might lean towards Carnival. Based on historic track record, okay? Historic track record. They pay quarterly, so we're now coming up to second quarter. Second quarter was 0. Second quarter here was 21, and then whatever. Second quarter 6, second quarter 7, second quarter 49, second quarter 0, second quarter 21, second quarter. Anyway, you could argue that Morrison's might be a better bet if you ignore that 415 and treat that as an anomaly. Then you can say that you're getting money relatively quickly, as long as you want to put that to one side and say that was out of character. But that's what the history is telling us. So enjoy making a decision. This week's economic calendar, Monday, 5:30 p.m., Bank of England, Broadbent speech. On Tuesday, we've got inflation reports coming out, and then we've got the CBI industrial trends coming out. Wednesday, look at this. We've got a whole slew of data. PPI output and input, inflation rate, core inflation rate, PPI, core output data, public sector data, core inflation rate, retail price index, month on month, year on year. Nothing on Thursday, and then on Friday we've got retail sales, including and excluding fuel. We've got Bank of England Wood speech, and then we've got CBI distributive data. And that's the economic calendar for next week. So that looks like a pretty comprehensive review of this week. What can we expect next week? Let's take a look at our crystal ball. And the crystal ball tells us there are 3 companies going ex-dividend next week: National Grid, Whitbread, and Sage. National Grid is promising 50.9%, Whitbread 14.7%, and Sage 7.8% for professionals, and non-professionals 19.7% and 3%. And if you just want to go for the dividend, then you can pick up a 3.8% dividend, 1.5% dividend, or a 0.8% dividend. This is dividend, and these are derivatives. Derivatives being spread betting or being CFD, okay? Words of wisdom. When you let your enemy write your history, your future is doomed. When you let your enemy write your history, your future is doomed. I remember actually reading something from Winston Churchill, the former wartime Prime Minister of England. And he said this: history is going to be very kind to me, because he was going to write history, his own history. So he had his own memoirs, and he decided he was going to write his own history. And he was going to see to it that the history books was kind to him, because he was going to make sure of it. So he's an example of he did not want his enemies writing his history for him, because his future reputation, i.e. post his death, his future reputation would be maybe not as pretty as he'd like it to be. And it's funny because some people who want immortality, there are people in certain so-called secret societies who consider that what people say about you years after you've died is a form of immortality. Your name, like, is immortal. And if they can say nice things about you, then you've got a good reputation. And he was thinking about that, obviously, and he wrote his own history. And I thought it was really instructive that he had that perspective of history. You could even argue that the pharaohs were exactly the same. The pharaohs wanted to make sure that history would speak kindly of them, even though the Jews in the Bible tried to undo, what they had written on their temple walls about themselves. Especially in the case of Ramesses II, the Jews weren't having it. But what I find funny is that I think the Jews are mixing up their pharaohs. So it is what it is. When you let your enemy write your history, your future is doomed. This is according to Ankh Eku from bettermarketingmastery.com. Okay, that's all for this week. Happy investing. Take care, guys.